On the surface, a Roth IRA is a fairly straightforward way to save for retirement. You contribute after-tax dollars, meaning you do not get a deduction when you make a contribution to a Roth IRA, but then the money grows tax-free, and when you retire, and assuming you follow all the rules, you can take your money out tax-free. But it turns out that if you don't follow all the rules, some really bad things can happen. You can, for example, be taxed on some or all of your distributions. You can also owe a 10% penalty, or I suppose if you really get unlucky, you could actually be taxed and owe a 10% penalty. So what I want to do in this video is walk through some of the rules that govern all of this, hopefully to help folks not fall into those traps. Now, I want to say this is very complicated. I'm going to look at show you a number of resources, mainly from the IRS, and I'll link to the primary resources below this video. But keep in mind, I am not a tax expert. This is my best understanding of what are very complicated rules, and so I encourage you to get professional expert tax advice before making any decisions. Now, I will include timestamps below this video because we're going to cover a lot of things, including 2 different 5-year rules, which you may have heard of. We're also going to talk about the backdoor Roth because it has some special characteristics that you may not know about when it comes to avoiding taxes and penalties. And then we're also going to look at what's called the ordering rules. When you pull money out of a Roth IRA, how is it considered? Is it a contribution? Is it earnings on that contributions? Is it a conversion? We're going to talk about that. So again, timestamps below the video. Now, to start with, there's sort of 4 ground rules that I always keep in mind when I'm thinking about a Roth IRA, and I want to walk through those quickly, and then we'll get to those 2 5-year rules I mentioned. So, what are the 4 ground rules? Well, the first is that there are basically 3 ways to get money into a Roth IRA. Well, I guess you could inherit a Roth IRA, but apart from that, there's basically just 3 ways to get money into a Roth IRA. You can just do a regular contribution. You contribute to open up a Roth IRA and put money in, a contribution. That's the first way. You could do a conversion or a rollover. A conversion would be you take a traditional IRA and you convert it into a Roth IRA. A rollover is very similar. You can think of it from taking a traditional 401k, getting it down to rolling it over into an IRA and converting it into a Roth. But we'll just refer to those as conversions generally. So you've got contributions, conversions, and then the third way, of course, earnings, right? Those contributions and conversions hopefully make you some money. You get some dividends, interest, the value of your stocks just goes up over time, and so you have earnings. Those are the 3 basic ways to get money into a Roth IRA, and I mention this because how they're treated by the IRS is different, right? And that actually gets us to our second ground rule, and that is contributions can always and for any reason or no reason at all be withdrawn penalty and tax free. You could wake up on a Tuesday and say, it's Tuesday. I'm going to withdraw my contributions from a Roth IRA. Now, I'm not saying that would be a smart decision to make, but you wouldn't get taxed or penalized. Contributions can always, at any time, be withdrawn penalty and tax free. That's the second rule that we want to keep in mind. The third one deals with the 10% penalty. We're going to talk a lot about that in today's video, but keep this in mind. If you're 59 and a half or older, you're not going to get penalized. You may get taxed, as it turns out. Believe it or not, you can actually pay tax on a Roth IRA distribution even if you're older than 59 and a half, but you shouldn't be paying that 10% penalty, or what the IRS calls the 10% additional tax. So if you're 59 and a half or older, you shouldn't pay that 10% penalty. That's going to come into play when we talk about conversions in just a minute. The fourth thing to keep in mind is what's called the aggregation rule. You may have 4 different Roth IRAs, or for all I know, maybe you've got 40 different Roth IRAs. The IRS doesn't care. They're going to treat all of your Roth IRAs as one big pot of money, all right? Which means you can't get disadvantaged, or you can't get any tax advantages by selecting which Roth IRA you're going to pull from. The IRS doesn't care. They treat it as one big pot of money. By the way, that then raises the question, all right, well, if I've got earnings and contributions and conversions in my one big pot of Roth IRAs, regardless of how many actual accounts I have, and I pull some of that money out, what's it deemed? Is it a contribution? Am I pulling out earnings? How does that work? We'll talk about that. That's called the ordering rules. It's very important. All right, so those are the 4 ground rules. With that, let's dive into the 2 5-year rules. And I'm going to tell you now, they're kind of like lightning and lightning bugs. They sound similar, but they ain't. And we got to keep that in mind. So the first one we're going to talk about, I call it the 5-year rule on withdrawing earnings. The IRS doesn't call it that. I'll show you what the IRS calls it. I call it that because it determines whether or not the withdrawal of earnings is taxed. That's very specific. It doesn't determine whether you pay the 10% penalty. We'll talk about that. It doesn't apply to conversions. That has a special rule. And as we know, contributions are never taxed when they're withdrawn. So this first 5-year rule is specifically determined, is used to determine, among other things, whether the withdrawal of earnings is subject to tax. Now, let me show you the rule. As I said, the IRS doesn't call it that. It's part of the definition of what the IRS calls qualified distributions. If you take a qualified distribution, you're not going to owe tax. And it defines what it is. And there are basically two parts of this definition. The 5-year rule here, we'll talk about that in a minute. Let's jump to number 2. The second rule for a qualified distribution, you've got to be 59 and a half or older. And then, as you see, there are some other exceptions to that. You can be disabled. It could be part of a first purchase of a first home. We know there are other exceptions to the 59 and a half or older rule. For our purposes today, I'm not going to dive into those exceptions. I'm just going to refer to being 59 and a half or older. And so that's a qualified distribution. You've held the accounts. We'll talk about this, but you've met this 5-year period. And for our purposes, you're 59 and a half or older. So let's talk about that 5-year period. And first, let's say, why do they add that? Why can't you just be 59 and a half or older? I mean, that's the sort of IRS age for being retired. Why have they thrown in this extra rule about this 5-year thing? And the answer is they want to encourage us to use Roth IRAs for long-term saving and investing. They don't want us to use this as a short-term vehicle for saving and investing money. And they've just defined long-term as 5 years. That's what they've made up. And so they want us to use these accounts for the long term, and they've defined that as 5 years. And that raises the question that, all right, Rob, fine, but how is that measured? And so it's measured in tax years. And so a couple things to keep in mind. If you opened up your first Roth IRA today, I'm recording this video in December of 2023, you said, okay, I'm going to make a 2023 contribution. I'm going to open up my first Roth IRA and contributed $100 to it or whatever amount you put in. Then 2023 is your first year of your 5 years. You could look at it this way. You could assume that the actual contribution occurred January 1 of 2023. You get full credit for 2023. It's based on the tax year. It's not based on, the specific day within a year you made your contribution. So 2023 would be year 1. Now there's another nuance here. Let's imagine you wanted to contribute in 2023, but you said, I've heard that I can actually make those contributions in the early part of 2024 before I file my tax returns. So I'll open up my first Roth IRA, say in February of 2024, and I'll contribute to it then, but the contribution I'll specifically designate it as a 2023 contribution. Raises the question, okay, when does the 5 years begin in that circumstance? And the answer is 2023, because that's the tax year the contribution was made for. So yeah, you could actually contribute in February of 2024, assuming it's for a 2023 tax year, and 2023 would count. Now that's the good news. There's some more good news, and then there's maybe some not so good news. The other good news is once you've satisfied this 5-year rule, you've satisfied it for all your Roth IRA accounts. You don't have to satisfy this for each individual Roth IRA account you may have opened. You may have 5 Roth IRAs for all I know, right? It doesn't matter. Once you've satisfied the 5-year rule for your oldest Roth IRA, you've satisfied it for all of them, including any you might open up in the future. Remember that aggregation rule we talked about. The IRS doesn't care that you own 37 Roth IRAs if that's how many you own. They treat it as one. So once you've had that oldest Roth IRA for 5 years, you're good to go. Now, that's the good news. There's some not so good news. Turning 59 and a half does not affect the 5-year rule. If you're 73, when you open up and contribute to your very first Roth IRA, you have to satisfy the 5-year rule. being 59 and a half or older doesn't satisfy this 5-year rule. It has no application to it. The 5-year rule is separate. In fact, if we go back to the definition of a qualified distribution, you can see the 59 and a half is down here. That satisfies the second requirement, but you still got to satisfy the first requirement. So again, if Warren Buffett himself in his 90s today opens up his first Roth IRA account and contributes to it, he has to satisfy the 5-year rule. And if you don't, now what happens if you don't? Well, if you don't satisfy it, remember, you can take out contributions, penalty and tax-free. So this 5-year rule doesn't apply to contributions, but you take out earnings and they're going to be subject to tax. You're going to have to include those in your tax return as part of your ordinary income, right? Again, we'll get to the ordering rules in a minute. Very important, but that's the downside to not satisfying this 5-year rule. Your earnings could be taxed. Again, we're going to talk about conversions separately in a minute, but remember, conversions are already taxed, right? You either converted non-deductible IRA contributions, which had been already taxed, or you paid the tax when you converted deductible IRA contributions. So you've already paid the tax on a conversion. The IRS isn't going to tax you twice on the same dollar. So that's already been taken care of, which is why this first rule applies to earnings. All right. And again, it doesn't apply to the 10% penalty, because if you're over 59 and a half, you're not going to have to pay that penalty. But again, you could get taxed if you don't satisfy this 5-year rule. So I know I've thrown a lot at you. I think if we understand high-level concepts, we get to the right answers. Again, I'll leave a link to the IRS document that I've shown you below the video. But that's the first 5-year rule. It's part of the definition of a qualified distribution, and it helps us determine whether earnings are taxed. Now, I want to stress one thing. Satisfying that rule doesn't mean you can take out money, earnings, anytime you want and not be taxed. Remember, the definition of qualified distribution includes the second requirement, right? So satisfying the 5-year rule is just one of the two things you have to do to avoid paying taxes on the distribution of earnings. You've also got to satisfy the second one, being 59 and a half. I want to stress that. Okay, now, what about the second rule? The second 5-year rule applies only to conversions, and it helps us determine whether or not we're going to owe the 10% additional penalty. Remember, we've already paid taxes on the conversion, so it's the second 5-year rule on conversions doesn't tell us whether we have to pay taxes on the conversions. We've already paid them. It only helps us to determine whether we're going to owe this 10% penalty. And to put this rule in some context, let's understand why we have it. So the first IRAs came out in the 70s. Roth IRAs were introduced in the late 90s. And at the time, you couldn't do a conversion from a traditional IRA to these new Roth IRAs if you made too much money. I believe the limit was $100,000. That changed effective 2010. They removed the income limits so anyone could do a conversion, right? All right, so that's just a little bit of background. Now, the question comes up, why did they add this pesky 5-year rule relating to this 10% penalty with conversions? Here's my best understanding. Let's imagine someone has a traditional IRA, and they've taken deductions from it. Each year they've made contributions, and they want to pull the money out before they're 59 and a half, and they don't otherwise have any of the other exceptions that apply. And they know they're going to have to pay taxes. They can't avoid the taxes. They pull money out, it's going to be taxed. But they're thinking, I'd really like to avoid that 10% penalty. I've heard that you can take out your contributions to a Roth IRA without paying that penalty. So you know what? I'll convert my traditional IRA to Roth. I'll have to pay the taxes, but I got to pay those anyway. And then once it's in a Roth, I'll take it out then. I mean, these are contributions, right? They feel like a contribution. I'm putting money into a Roth IRA. And this will be my sort of sneaky way to trick the IRS and get around that pesky 10% additional tax. And the IRS said, yeah, you know what? We're kind of clever over here. And we've actually thought that out. And so to avoid that cleverness, we've got this 5-year rule. And that way you can't do that. At least if you're going to do it, you have to wait 5 years. Now let me show you the actual rule. We're going to this same document that I'll link to below the video. This is where we saw the qualified distribution definition. They even give you a fancy flow chart that you can follow for that if you'd like. And then we get to this additional tax on early distributions. And specifically here, conversions and certain rollovers. And they basically give out the 5-year rule. If within the 5-year period starting from the first day of your tax year, so again, this gets measured based on tax years, you convert an amount from a traditional IRA or do a rollover from what they call a qualified retirement plan, think 401k, you may have to pay this 10% additional tax on early distributions. Now, a couple things to keep in mind about this rule. Remember with the 5-year rule on earnings, once you satisfied it for your oldest Roth IRA account, you satisfied it for all of them, right? That was the aggregation rule. But the second 5-year rule doesn't apply at the account level. It applies specifically at each conversion. And so the 5-year rule applies for each conversion separately. So if you do a conversion in year 1, for that conversion, the 5-year clock starts. And then the next year you do another conversion, you've got a brand new 5-year clock that starts with that second conversion. And this is important to understand because what a lot of folks will do, particularly maybe after they've retired, but before they start receiving Social Security, or perhaps before RMDs kick in, they'll do some conversions every single year. Well, you've got a 5-year clock that starts with each and every one of them that you have to satisfy. And if you don't, you may have to pay that 10% penalty. Yes, there is, I think, an interesting exception when it comes to backdoor Roths. We'll talk about that in a minute. But here's the other thing that I want to mention. Remember the purpose of this rule. It was to keep us from trying to do an end around the 10% penalty when it comes to traditional IRAs. But remember, once you turn 59 and a half, there are no 10% penalties, right? If you're 60 and you're doing a conversion, you're not doing it to try to get around the 10% penalty rule because you're 59 and a half or older. You don't have a 10% penalty. So this rule, unlike the first one on earnings, which applies regardless of your age, once you turn 59 and a half, this 10% penalty doesn't get applied even if you pull out conversion money within the 5-year period. Once you turn 59 and a half or older, this 5-year rule, you could sort of deem it as satisfied and you won't pay the 10% penalty. There's no reason for that rule anymore. It's the reason for it no longer applies because you're 59 and a half or older. Okay, so those are the two 5-year rules as best as I understand them. And by the way, if you have a different understanding, feel free to leave a comment below the video. We can all learn from it and we're all here to learn. So now we've got 2 more things to cover. I mentioned backdoor Roths and then we got to talk about ordering rules. Very important. So I know, and if you've stuck with me this long in this video, you're a mensch. Okay, so let's talk about backdoor Roths. I came across this article. I'll link to it. It's from a site called the FI Tax Guy, Financial Independence Tax Guy. I don't know who he is, but he mentioned he has a section here, the 5-year rule on Roth IRA conversions in the backdoor Roth. And what he says is that, and I'll link to this article, but what he says is when it comes to a backdoor Roth, assuming that you're converting non-deductible IRA contributions. So you make too much money to deduct your IRA contributions. You put money into a traditional IRA and then you sort of immediately move it over to a Roth. That's a conversion, right? But when you did that, the conversion didn't trigger any taxes, right? Because you'd never taken a deduction on those IRA contributions because you weren't allowed to. And what he's saying is for conversions that aren't taxed at the time of the conversion, you will not owe the 10% penalty, even if you take the money out within the 5-year period. And I'm thinking, I've never heard of that. I mean, he might be right, but that was really curious to me. So I started digging in and doing some research, and here's what I found. If we go back to this document that we were looking at before, remember we were looking at this section here on conversions, the 5-year rule. Now look at this sentence right here. It says, you must generally, I always love to say generally, it's not always, it's generally, pay the 10% additional tax on any amount attributable to the part of the amount converted or rolled over that you had to include in income. Huh. maybe this guy is right, because if you're converting non-deductible IRA contributions, when you convert them, you don't have to include that money in income. You've already paid the tax on it. And so my best understanding, based on the first article I showed you and the IRS document, is that even if you violate this 5-year rule on conversions, you do not have to pay the 10% penalty to the extent that the conversion didn't trigger taxes. You didn't have to report the conversion on your income tax. Hope that makes sense, but that raises a big question. What if you convert money that includes both non-deductible contributions to an IRA, but also some earnings? Because maybe you didn't get around to doing the backdoor Roth right away. Maybe it sat there for 3 months and you made $100 in earnings. And so when you made the conversion, most of it didn't have to be included in your income, but maybe $100 did, or in some cases, maybe it's a lot more. But for an example, let's say $100 had to be included in your income when you did that conversion. What the FI tax guy is saying, and this makes sense based on the IRS document I showed you, is you would have to pay a 10% penalty if you withdrew that conversion before the 5 years was up, but only 10% of that $100, not 10% of the entire conversion. That's my best understanding, and it raises a big question. It goes back to this ordering rule. Well, what if I take out $100 exactly? Is that the part that has to be subject to 10% penalty or not? And it raises the bigger question. I might have contributions and conversions and earnings in one or more Roth IRAs. If I take out 5,000, let's say there's 100,000 total, how does that get deemed? What is that? Well, fortunately, there are ordering rules. I'll show you where they are here. You can see them. They're right here, ordering rules, in this same document, and here they are. But let me explain to you my understanding of them. I think this is fairly straightforward. The order goes like this. And again, remember, it doesn't matter which Roth IRA you draw from. You could have 15 different Roth IRAs. They're all treated as one. The first thing that comes out are all your contributions. And that's good, right? Because they're penalty and tax free. So all of your contributions come out first. Once you've withdrawn an amount equivalent to all of your contributions to all of your Roth IRAs, then the conversions and rollovers start to come out. And within that second layer, the first part of the conversions that come out are the conversions that triggered taxes at the time of the conversion, meaning that portion that would be subject to a 10% penalty if you withdrew the conversions before the 5 years was up, right? Now you say, well, wait a minute, Rob, I do conversions each and every year. I get that on any one conversion, the amount that triggered taxes comes out first, and then the non-deductible contributions I converted comes out second. But what about multiple conversions? Well, it's first in, first out. So your oldest conversion comes out first. Within that conversion, anything that triggered taxes is deemed to come out first. Anything that didn't trigger taxes at the time of the conversion comes out second. Then you go to your next oldest conversion and do the same thing, and then your next oldest conversion, all the way up through all of your conversions. And then once all of your conversions, and I guess rollovers too, right, have been withdrawn, you're left with earnings. Earnings come out last. So it's contributions, conversions, first in, first out basis, and then earnings. Yeah, I know it's kind of makes your head spin. I get it, and I'm doing my best to sort of walk through this as straightforward as I can. I will leave you with one last thing before I mercifully end this video. You really want to keep good documentation. There are tax forms, for example, if you make a non-deductible IRA contribution, there's a tax form that you file. You're going to, same thing with Roth IRA contributions, distributions, you're going to get some forms from your brokers. You want to keep all of your documentation and file the right forms with your tax returns, because you're going to want to be able to prove these are all the non-deductible contributions I made to my IRAs, and here are all the conversions that I did and when I did them, and here are all of my Roth IRA contributions. So you know all of those numbers, so you can prove it to the IRS if you're ever audited, and also just so you can do the right thing and account for this properly. Keep all of your documentation, file all of the correct tax forms. Obviously, if you're using tax software, it should walk you through that as you answer the various questions, or if you're paying someone to do your taxes. They should obviously know all of this, but you're going to have to let them know about this. I think some folks say, well, it's a non-deductible IRA contribution. I mean, it's non-deductible, so I don't need to file anything, right? Wrong. There's an actual tax form for non-deductible IRA contributions. You want to make sure you file that and keep a record of everything. Well, there you go. I know it's a lot. My best understanding of all of these rules. If you think I've missed something or gotten something wrong, you won't hurt my feelings. Put a comment below this video so we can all learn. I'll leave links to the things I've shown you as well. And of course, if you have any questions, leave them in the comments below. Be happy to help you out any way I can. Until next time, remember, the best thing money can buy is financial freedom.